Sophia Financial Group is a full-service financial planning and investment management firm located in Vancouver, BC on the west side. Since we opened, we've been dedicated to delivering excellence in professional, holistic investment management and creating a platform for financial inclusion, education, and inspiration. We believe that money is power, the power to create personal peace of mind and the power to make the world a better place. Wise Money Talks is part of our Sophia Wealth Academy online education program. Our objective is to help you gain control over all aspects of your relationship with money. I am so appreciative of our incredible speakers who so willingly share their time, energy, and wisdom with us. And I'm grateful to our webinar hosting and marketing teams for managing all those backstage details and everything that goes into presenting these wonderful speakers and their important life-changing messages. Before we get started, I encourage you, keep your screens on. It makes the process a lot more engaging and gives us more of a sense of that community, the kind that we'd be building if we were still here in our boardroom at Sophia. We welcome your questions, but if you're shy, feel free, instead of raising your hand, just add them into the chat bar and we'll address them at the end of the session. Joanne keeps track of that. Today, we'll only be doing an audio recording, no video on the speaker's presentation, but the audio recording will be sent to you and added to our YouTube channel. So here we go. It is my pleasure to introduce you to tonight's speakers, Nadeem KASSAM and Dr. Luiz FURLANI, who will be giving us a market update and a peek into what to expect in 2022. I know that for many of you, understanding the financial markets and their impact on the economy, as well as matching that up to your personal financial situation, can sometimes be daunting and confusing. But for Nadeem and Luiz, it's a dynamic and fascinating topic. They are both incredibly passionate about, and one they look forward to sharing with you today. Nadeem is the head of investment strategy for the private client group with Raymond James. He has over a decade of capital market experience. He previously worked in the investment strategy group at CIBC Wood Gundy, where he co-managed 6 North American equity-only and balanced strategies with top quartile performance, helping to grow assets under management in the portfolios to over $3 billion across platforms. Luiz is an associate investment strategist with Raymond James and has worked on both the institutional research and buy side with firms across North and South America. Dr. FURLANI previously worked with the Canada Pension Plan Investment Board, where he was responsible for generating economic and financial forecasts for the global markets. Both of these well-respected speakers will provide an overview today of current interest rates, valuation, inflation, and economic policy, and their impact on major asset classes. They're also going to discuss short and long-term perspectives on portfolio management. And on that note, let's dive into the money markets. Thank you. Over to you, Nadeem and Luiz.
Thank you, Tracy, and good afternoon, everyone. We really look forward to sharing with you our economic update as well as our outlook for 2022. Keep in mind that we've allotted more than 20 to 30 minutes at the end of the presentation for Q&A. So keep them coming out into the chat room, and we'll definitely get to them towards the presentation, if not during the presentation. So without further ado, I'll start the presentation and we'll get right to it. So again, thank you everyone for joining us. We are very excited today to be presenting to you our views on the market as we look towards the end of 2021 and especially as we look towards 2022. So to state the obvious, it's been a rather unique couple of years with many firsts for all of us. For me in particular, on a personal level, I became a father for the first time this year and experienced what it really meant to go days on end without sleep. However, for many of us here today, we experienced similar firsts over the past couple of years, including having our lives disrupted by the COVID-19 pandemic and the subsequent lockdowns and restrictions that would follow. As of last check, COVID-19 has infected almost 215 million people, with more than 5 million innocent lives lost across the world. Moreover, due to the globalization and the integration of world economies, the spread of the virus was not contained to where it first emerged, in this case, Wuhan, China. Rather, it spread rapidly and globally to all corners of the world in a matter of months. Relative to past pandemics, the COVID-19 pandemic has been the most severe we've seen in recent decades, but thankfully not as deadly as the Spanish flu in the 1920s. We believe that the rapid and coordinated efforts by various stakeholders, including policymakers and healthcare professionals globally, to develop a vaccine in record time, coupled with global lockdowns, travel, and stay-at-home restrictions, were critical at minimizing the loss of life, which so far has been substantially less than the last major pandemic, which we saw during the early 1920s. However, these harsh restrictions did result in the shutdown of global supply chains, the wrath of which we're still facing the consequences of, including large segments of major economies in the early days of the pandemic. And while critical to help mitigate the spread of the virus, minimize the loss of life, and the strains on the healthcare system, these harsh restrictions had a severe impact on the global economy, which, as you can see on the chart here, contracted by 3.1% in 2020. And on almost all measures that we track, it is by far the worst recession in recent history, including relative to the financial crisis, which contracted just in slightly in 2007, 2008, and substantially worse than the dot-com bubble, which for all intents and purposes was more concentrated was concentrated in the US as opposed to a global economic slowdown, which we saw with the COVID pandemic, as well as the financial crisis. I'm sure many of you can likely recall there was tremendous uncertainty on the outlook at the onset of the pandemic, which, coupled with global shutdowns, travel restrictions, stay-at-home orders, resulted in a deep sell-off in global stocks. However, relative to the gradual declines, that we've seen during the past two recessions of anywhere between 40 to almost 60%, the sell-off in global stocks in the early days of the COVID-19 pandemic, or specifically during Q1 here of 2020, was concentrated in just over a 1-month period. This is yet another first as it relates to the magnitude and also the pace of the sell-off in equities going far back as the 1980s. To help offset the worst contraction on record, local authorities added unparalleled levels of stimulus, and in Canada, and specifically fiscal stimulus. And in particular in the US, we saw CARES, CERB and CEWS in Canada, and countless others. These measures, while another first for many of us, effectively blank checks, and I wouldn't say blank checks, but checks that were deposited in everyday citizen accounts, were absolutely necessary to support those adversely impacted by lockdown measures and critical to mitigate a much worse and drawn-out recession. Simultaneously, though, just as economies were heading into lockdown, central banks reacted strongly by slashing interest rates to record lows, making financial conditions highly accommodative and supportive for global growth. The outlier here in gold was China, which, due to several unique factors, including the communist government's ability to implement and enforce strict lockdown measures, enabled the economy to reopen within months of the first infection, which resulted in minimal impacts to its economy in the early days, as well as up until recent months, and thus the need for less loose financial conditions. However, the situation has shifted quite significantly in China, which currently appears to be in a loosening phase, while other regions across the globe appear to be modestly tightening. So where are we today? For starters, investors we speak with on a daily basis, both institutional as well as retail, are nervous as they look out at a wall of worry. And this wall of worry includes uncertainties related to one, the path forward on COVID-19 and the possibilities of new strains arising and disrupting the recovery and the markets. Two, the potential for new lockdowns and restrictions, which again could weigh on the global economic recovery. As a reminder, just last week we saw China clamping down at Shanghai, their Disney theme park in Shanghai, which is a sign that we're not necessarily entirely out of the lockdown phases of this recovery. Three, what to buy, sell, and how to position given the strong market performance over the past year. Four, the impact on portfolios from rising rates and the policy normalization that we're seeing. And finally, five, inflation. Are we set to see another period of surging inflation like in the 1970s, or is it just transitory? We will tackle each of these in the preceding slides and demonstrate why, despite the numerous risks, uncertainties, or wall of worries, if you will, on the horizon, we still remain rather positive on the outlook. So for starters, we believe vaccines work, and the full vaccination of the global population, or at least the built up of some level of immunity, remains paramount to the reopening of the global economy, and also will dictate the strength, length, and level of participation we see across regions moving forward in the recovery process. Many regions across Asia early in the pandemic adopted a zero COVID policy by deploying strict lockdown measures and contact tracing to fight the virus. However, more recently, these measures have shown to be unsuccessful against the more contagious strain of the virus, namely the Delta variant. And while we don't claim to be medical experts here, we have seen regions that have successfully vaccinated a majority of their population see their economies emerge from lockdowns and avoid new restrictions. For example, as of the end of June, only 8%, and it's demonstrated right here in this chart, highlighted in blue, 8% of the global population was fully vaccinated, with Canada, the UK, Germany, and the US leading the charge. If we fast forward a few months, the percentage of the global population which was fully vaccinated had risen to 34% as of the end of September, up from 8%, as we mentioned in the previous slide, as of the end of June. Advanced economies are leading the way, but this is changing quickly as several countries across Asia Pacific region have abandoned their zero COVID-19 strategy and vaccinating their people. China remains the only region still following a zero COVID policy, but they've made serious strides, as you can see here, with approximately 71% of their population being vaccinated as of the end of September 30th. As mentioned, we believe vaccination efforts will be a critical factor dictating not only the path forward for the global economy, but the pace and strength of the recovery process across regions. Lockdowns, as we've seen, impact supply chains, which impact supply demand of goods, which impact economic activity in regions across the entire supply chain. It also results in inflation, both cost and labor increases, which has an adverse impact on economic activity in some cases. That said, we expect the worst of the COVID-19 related supply chain disruptions caused by shutdowns across Asia and elsewhere in the world to be largely behind us and should begin to moderate as we look forward over the next couple of years. In fact, one of the industrial analysts on the street, namely from JP Morgan, announced today that they're seeing signs of improvement, which is a positive and consistent with our views. The key thing to keep in mind, though, is that supply chain bottlenecks are not unique to this recovery, rather just more extreme in nature due to COVID and the on again, off again lockdowns that we've seen across supply chains. We believe, again, the tide has turned and the outlook remains positive as it relates to supply chain normalizations. And leveraging Google mobility trends, we're also seeing a path towards normalization for most sectors in Canada, although a few are still far from pre-pandemic levels, such as activity in the workplace and transit stations. The latter two, we believe, have been impacted by more structural changes, including the stickiness of work from home, from the work from home model that many companies have embraced, including Raymond James. And as such, we don't expect a full recovery back to pre-pandemic levels in the near term. Likewise, we're seeing similar trends in the US. And more importantly, though, we're seeing a similarity in terms of seasonal trends as it relates specifically to parks. Given the improving outlook since March of 2020 lows, markets have rallied. And while it may appear that the best days are behind us, again, another worry for most, we believe the contrary remains true. There are uncertainties on the horizon. However, the outlook remains strong and is supported by A, rising vaccination levels globally, B, the reopening of economies, C, still very accommodative fiscal and monetary conditions, and D, strong corporate and household fundamentals. On the monetary front, we saw central banks step up in a very big way in 2020. For example, the Bank of Canada, as you can see on this chart highlighted in dark blue, increased their balance sheet by almost fourfold, while the Fed almost doubled its assets from pre-pandemic levels. So you see this massive step up that we saw from pre and up until today as it relates to the balance sheets of some of the major central banks globally. And while we expect to see some policy normalization, we've heard this from both Bank of Canada and the Fed, we do not believe that the global central banks will remove stimulus at a pace that would derail the recovery. And this is another worry that is quite topical on the minds of investors. In fact, the Fed, Bank of Canada, and even the ECB and many other central banks have communicated exactly that. Moreover, we do not expect interest rates to move materially higher over the near term. Rather, we expect central banks to raise interest rates once their monetary stimulus programs have been normalized. Bank of Canada, just a week ago, ended their QE, and the Fed reduced their asset purchases by $15 billion a week. Despite expectation of normalization of policy and higher interest rates on the horizon, on all accounts, we still remain in a very highly accommodative environment. This bodes well for stocks, less so for bond investors who do not hold to maturity, as well as bond-like investments. But volatility should be expected as policy begins to normalize. Again, this is very normal and typical of each and every cycle that we've looked at going back to the early 1950s, if not further. At around $17 trillion, total government fiscal support since January of 2020 till the end of 2021 was larger than the GDP of the European Union and close to the level of GDP of the United States. So let that sink in for a sec. The level of fiscal support is close to the equivalent to the GDP of the US, the largest economy in the world. This support has been filtered down to companies and, most importantly, where it matters most, down to the consumer level. Overall, we've seen advanced economies provide the most stimulus to businesses and individuals, while some emerging economies have begun to start reducing these level of support. All the stimulus and support has led to one thing: excess savings at the consumer level. And you can see on the right-hand side, Canada tends to be leading the chart, followed by other developed regions as we move from the right to the left. This, in our view, reflects ample pent-up demand or potential spending that could be drawn down in the years ahead. While this level of spending will be unleashed, and while the level of spending will be unleashed and to what degree remains the main unknown here, our work shows that even the drawing down of a small fraction of these savings would be a strong catalyst for the economy, especially if those dollars are spent locally. So while some fear the best days are behind us and the end is near, most indicators that we monitor suggest the economy is still in the early to mid phase of the business cycle, which is historically quite favorable for most asset classes, in particular stocks. Business cycles going back to the early 1920s, as shown on this chart, has lasted on average of 8 years in Canada, with the shortest being about 2.6 years in the 1950s and the longest being 17 years.
Yeah, I mean,
for context, the last cycle lasted at about 11 years, and we expect more is definitely left in the tank despite the wall of worries that we see and hear so much about. This is the slide that matters most. What's the outlook for global inflation? So there's been 3 major factors behind the persistent surge that we've seen on inflation. The first being significant demand. Remember in one of the previous slides, the stimulus that we've seen in the past year and a half has been equivalent to the US GDP, and it's filtered down to companies and consumers alike. It has to go somewhere. 2, supply chain disruptions, which has been the result of lockdowns across Asia due to their zero COVID policy and labor shortages, which have been exacerbated by the gray wave of very accommodative fiscal programs, which have effectively paid people not to work, along with higher commodity prices. And while we have not seen significant wage inflation yet, which in our view would be more sticky as a driver inflation over the long term, persistent labor challenges and the unwinding of fiscal programs could support the case for more persistent of inflation over the near term. Due to several factors, we expect inflation will remain above trend over the next couple of quarters. That said, while we expect many of these driving forces behind inflation to resolve themselves, we do see risks to the upside over the next couple of years. The IMF is expecting above trend inflation in 2021 and 2022, with a trend toward some level of normalization in the years following. So I'm going to pass the slide over to Luiz, who will now provide our Canadian outlook.
Thanks, Nadeem. And it's a pleasure to be here. So as it relates to the outlook for Canada, it still remains strong, but there are likely some bumps along the way to the recovery. So let me start talking about the outlook for growth. There's been some near-term softness in the economy in Canada, especially if we look at the monthly GDP numbers that we've seen recently. But despite this near-term softness and some risks in the horizon, Nadeem mentioned a few of those, growth still remains above trend, and we expect it to rebound as the 4th wave of the virus loses steam and risks begin to ease in the years ahead. And by risks, I mean risks such as supply chain disruptions, housing, and labor challenges. We expect gains in income, employment, and savings to fuel strong growth in consumption and business investment next year. We also expect firms to continue to rebuild their low inventory levels. And while there is risk that GDP growth expectations continue to decline from peak levels we saw in July and August, there seems to be sufficient buffer for real GDP to slow further in 2021 and 2022 and still be above trend. As of last check, the street consensus was calling for real GDP growth around 5% in 2021 and at around 4.2% in 2022. Just as a reference, the 10-year historical growth rate is 2.2%. So that is considerable, that is way above historical growth rate. One of the main drivers of that above trend growth should be consumption. Household income has surged thanks to generous government transfers, as Nadeem mentioned, which makes us confident that consumption will continue to recover even with recent headwinds. And by that, I mean things such as the end of some of the pandemic-related benefits. We see the level of savings is elevated. It's around 14% now. And sooner or later, that will find its way back into the real economy, which means that household savings should head back toward the long-term historical average. And again, will be one of the main drivers of consumption and growth. Looking at the labor market is another area suggesting the outlook for the consumer is looking good. Employment continues to shift higher and wages are increasing. Also important to note are some forward-looking indicators, such as business and consumer surveys. Numbers from those two surveys are consistent with further gains in investment and consumption, which should keep domestic demand growth relatively strong in 2022. Looking at residential investment, we expect it to fall from its elevated level, particularly in 2023, after borrowing costs are expected to rise further. We expect this will be one of the factors pulling down domestic demand growth from elevated levels. Inflation, as we see here, inflation is high and is one of the hot topics of the moment. It remains above 4%, boosted by base year effects, commodity prices, pandemic-related supply bottlenecks. These are the factors pushing inflation up. We recognize that their persistence and duration could cause upside risk to inflation over the near term, but we believe inflation to be transitory. It's just taken a little longer than we expected to come down, but we do expect inflation to come down.
Luiz, can I just ask a quick question?
Of course.
On this slide, what do you mean base year effects?
During the pandemic, what I mean by that is just a statistical effect caused by the pandemic. When we look at inflation, the annual inflation is just the index at some specific month divided by the index of the same month from the previous year. So for instance, during the pandemic, let's take March 2020 as an example. If you are in March 2021 and we compare inflation in March 2021 and we look at March 2020, economies were in lockdown, were closed. So the index was really low in 2020. And when we look at inflation, there's this huge jump in March 2021 caused basically by this, let's call it this statistical effect, which of course reflects inflation, but it reflects, in my opinion, more of what happened in March 2020 than what was currently happening if we were in March 2021, for instance. So it's a good information when we look at the
comparative.
Exactly.
Okay.
Exactly.
Thank you.
And there's some good news on the inflation front as well. I'm going to just talk about 3 of those. The first one is that core measures have risen, but by less than the headline number. Number 2, medium and long-term inflation expectations remain well anchored. And this is very important, particularly if we think about monetary policy. And the third thing is that, as Nadeem mentioned, we see no price wage spiral. This would mean basically if we saw that, that would indicate or suggest that inflation pressures were more persistent than we currently expect. Just as a reference, nominal wage increases are around 2%. That is way below inflation. So it basically means that wage increases are not even covering inflation. If we move on to the next slide, we see that the economy is recovering, but still needs a lot of support. That's one important thing to note. And by a lot of support, I mean monetary and fiscal stimulus. On the monetary front, the Bank of Canada, following its latest monetary policy decision, maintained its target for the overnight rate at the effective lower bound of 0.25%. It also maintained its extraordinary forward guidance on the path of the overnight rate, but, as Nadeem mentioned, ended quantitative easing. This does not mean that the Bank of Canada is reducing stimulus. It is in what they call the reinvestment phase. As bonds mature, they buy more bonds. But it only means that the bank's not adding more monetary stimulus. That's the message from the end of quantitative easing. And even though we see that the yield curve has steepened, as we can see from the chart here on the screen, financial conditions are still very accommodative. That said, high inflation and higher yields are not all that bad for equities. Going back to periods of rising inflation and yields since the 1990s, we see that these periods resulted in positive equity returns in around 70% of the time. In particular, when rising inflation and yields resulted from improvements in the economy, which is something similar to what we are seeing today. And finally, fiscal policy. Fiscal policy is very accommodative, and we believe that changes in policy will likely be measured, and we do not expect those changes or the removal of stimulus to derail the recovery of the economy. The final thought for investors. The outlook for the global economy remains robust. As Nadeem mentioned, there are fears of a slowdown, but forecasts for growth are above trend using IMF data. If you look at the IMF forecast for the global economy, the IMF's forecasting a growth rate of 5.9% for 2021 and 4.9% for 2022. The historical real GDP growth rate since the 1960s is around 3.4. We expect advanced economies to lead the developed world due to higher levels of vaccination and stronger stimulus, both fiscal and monetary. Even with some near-term softness in the Canadian economy, we expect above trend growth both in Canada and in the US in 2021 and 2022. Inflation has picked up momentum around the world. And although some recent factors pushing it higher, like supply chain disruptions, are likely to moderate as we move further into the cycle, we still see significant near-term risks to the upside for inflation. Risks in our view are asymmetrical and are tilted to the upside over the next couple of years. The level of uncertainty is high. Beyond inflation and fears of a slowdown, Nadeem talked about the wall of worries. Includes a lot of things like the path forward on COVID-19, potential new lockdowns, restrictions impacting the global economic recovery, impacting markets, how to position in markets given the strong market performance, impacts on portfolios from policy normalization, rising rates, and so on. Despite all this, we want to remind investors that the time to worry is when no one else is worrying. And the time to be buying is when everyone else is selling. We have good examples of the former in 2019 Q4, and we have a good example of the latter in 2020 Q1. Two more points to here. The first one is that we see good opportunities in equity markets across most advanced regions, as well as select developed markets, and we still favor equities over bonds. And finally, maintaining a well-diversified portfolio with a strong asset allocation strategy should help minimize volatility and increase the chance of reaching one's objectives and goals. Thank you so much.
Thank you. Any questions out there?
Luiz, thank you so much for your presentation. One question that kind of comes to mind is that if the forecast for bonds are negative returns, what position or what role do bonds play in a portfolio if they're just gonna eat away at our investments?
Okay. Well, there are, a few roles that not only bonds but other asset classes play in a portfolio. So when we think about bonds, for instance, we believe that bonds, well, as we said, in our base case scenario, the economy is expanding. We expect, while inflation is high, and central banks are starting to remove some of the stimulus. And as governments do that, of course, bond yields, or we see the yield curve, as I mentioned, steepening. And this, of course, is not very good. It's a headwind, if you will, for fixed income returns. So it's depending on which bond you're talking about. Bond returns might be, I would say, low or even negative for some of the bonds. But even with that, bonds, even considering that bonds add, when you think more broadly about the portfolio, there are some diversification benefits of adding bonds to a portfolio. So by doing that, and of course this is going to be, well, each investor will have their own share of their portfolios invested in bonds based on their, return objectives, their risk, the way, how can they tolerate risk, and their risk preferences, if you will. But bonds play a role, add to diversification, and thus tends to increase the risk-adjusted return of the portfolio. And that is not only bonds. You can think about other assets as well. Last week we published a piece on gold, and gold has similar characteristics. It acts it's a good diversifier. It performs well when other assets are not performing that well. In a way, bonds had some of that. So think about recessions, for instance. Equities tend to perform very poorly during recessions. Bonds tend to perform better, and gold tend to perform well during recessions. That's when, for instance, gold shines. If you think about other phases of the business cycle, as Nadeem mentioned, you see equities performing really well in the current environment between early and mid cycles. In that environment, gold do not perform that well. Same with bonds. So basically, the short answer would be about bonds, going back to your original question, would be gold and fixed income or bonds would add to the portfolio, would have some diversification benefits in the portfolio, and will improve risk-adjusted returns. The amount of bonds that an investor should hold will depend on the investor risk preferences and return objectives.
Thank you, Luis. So it sounds like bonds kind of provide the protection in the portfolio when there's market instability and volatility. Perfect. Nadeem, just a question for you is how do you see the Canadian real estate market performing over the next couple of years? It kind of seems like the real estate market here, at least locally in Vancouver, kind of it kind of goes ahead, beats according to its own drum. It doesn't seem very affected by outside global economic conditions. What do you think about it?
Yeah, so I think it goes back down to the unprecedented environment that we're in, right? Real estate behaves very similar to bonds, believe it or not. If we go back to the 1970s or let's say late 70s, early 80s, and when interest rates were going through the roof as a result of the inflationary pressures that we saw during that environment, we saw housing, we saw bonds underperform, right? So I think it's something that, if we take a step back, the real estate market in Vancouver, the real estate market in Canada, the real estate market across the United States, the real estate market across Europe, believe it or not, they're behaving very similarly. In China right now, we're having a housing crisis. Why? Because they're trying to slow that economy, which is for the most part 1/3 driven by housing. So if we kind of look at, all right, what's our outlook for housing? What do we think is going to happen? I think there's definitely been the biggest fundamental driver for housing is interest rates, right? So at the end of the day, this is by far the most levered investment anyone out there would purchase, right? After a vehicle, if you will, and then going to for undergraduate, postgraduate studies, that's costly too, if you will. But if you think about actual purchases that all of us, we need shelter, and there's just not enough of it in Canada. Okay, and if we look in the U.S., the sales to inventory ratio, there's been a focus on densification there, similar to Canada, similar to the UK. So if you look at housing policy globally, it's been fairly consistent. Add on the same factor that's been at play, which is interest rates, which have only gone lower, and continuous support, if you will, from the economy. So from an economic policy perspective. So where does housing go? Hard to say, right? But I think with higher borrowing costs, loosening or tightening of stimulus, there should be some moderation in what we've seen in the housing market so far. But it's really hard to tell, because at the end of the day, I would have for sure betted against the housing market at the early days of the pandemic. Okay, so I could tell you right now, my view on housing was very negative at the beginning of March of 2020. And by the end of March of 2020, based on the policy support and all these programs that were announced, I was like, wow, the bailouts, the rent relief, all these programs that we've never seen before, payroll protection, it's something that I've never seen. So at the end of the day, there's a lot of risk to the economy if the everyday consumer fails and they can't pay their mortgage. We have a highly regulated banking industry which can't weather that. So I think there's going to be some moderation in housing here. But again, I would say that is going to be moving in lockstep with what we expect from the policy standpoint, right? So if we start getting higher interest rates, more normalization in policy, that will have an impact. But again, from a supply perspective, from a demand perspective, from an immigration perspective, there's quite a bit out there that really will put a floor in how low we go. So yeah.
Thank you.
Luis, did you get the question from Rudy?
No, I didn't.
No, okay. So her question is, what will the impact of new climate emergency measures promised by various governments this week in Glasgow, like changes to fossil fuel supports and industries, what impact will that have?
Do you want to take that, Nadeem?
Yeah, sure. So we've done quite a bit on the environmental ESG side of things, and we've been evaluating quite a bit on the whole environmental movement, if you will. And I'll first and foremost say that this is a global issue and not a Canadian issue, and not a oil sands issue. Okay, so that's right off the bat. I think that the promises made over the past week were not much of a difference in terms, like there wasn't much net new information, if you will, but just again more a forum where policymakers globally essentially came together and strategized. This is not something that Canada can fix on their own. This is not something the US can fix on their own. It's a global issue that needs to be addressed in unison. And we saw this a few weeks ago where various regions came out and said, look, we need a global minimum tax. It's again something that is a shift from what we've seen historically, or at least the early signs of a shift that we're seeing, which is away from, more populism and more regional policies to more of a global coordinated policy. As it relates to this, the promises made on the climate side of things, we're not of the view that this makes a huge impact on industries in Canada. Majority of global fossil energy is produced through burning of fossil fuels. My previous role prior to joining Raymond James was in equity research with RBC, where I covered the infrastructure space. It takes years to get spending in the ground, whether it relates to any type of fiscal infrastructure, if you will. And that relates to pipelines, and that also relates to nuclear facilities, wind farms, you name it, right? So if we wanted to tomorrow to shift our usage of ICE vehicles or internal combustion engines to those that are EV powered or hybrid, there's not enough supply in the market today to meet that. There's just not enough out there to do that. So what the key takeaway is that there is a huge emphasis to make a sustainable and a measured shift towards initiatives that are sustainable over the long term, both from an energy, from a social, environmental perspective. And these changes are not going to happen overnight. They just aren't. And so in our view, one of the best examples is Enbridge and TransCanada. And you look at them and say, okay, well, these companies are screwed because Keystone, for the second time, was essentially kiboshed, first by the Obama administration and then by a quasi-Obama administration here, which we have in the White House. And so, getting pipelines infrastructure is going to be difficult. It's only get more tougher. That said, these are very solid infrastructure businesses. They can lay pipe, they can put out storage facilities, refining capabilities, all that stuff. What they're currently focused on now is carbon capture infrastructure. So again, it's as the focus of global regions shifts towards more of more of a a climate-oriented strategy, there's sustainable ways for businesses across various industries to participate. And so the two being Enbridge and TRAP, right? Like they're in the energy sector, but they can actually provide infrastructure that supports the carbon capture within the environment, right? So I think the key takeaway here is that we have some of the best energy companies, some of the best businesses here in Canada that are heavily, heavily regulated. I would rather buy Canadian oil sands than buy oil from the Saudis, right? Like if you think about how regulated it is, both from a labor standpoint, from an environmental, and so on and so forth. All eyes are on the sector, right? So I would say I wouldn't be quick to brush every sector with the same tone, if you will, right? So I think these strategies that were discussed and the policies that were obviously shared at COP26, I think are very important and will be guiding light for the future, but they're not going to change they haven't changed our view on the outlook of the Canadian economy. And I would caution investors to think that any of these strategies will be implemented overnight. It's just not going to happen.
Well, that's, I guess, great from an economic point of view, but a little discouraging from a climate protection point of view.
So I think where again, I think it's reality, right? Like we can't shift the economy on a whim here to be one that is more fossil fuel oriented to renewable overnight. But I think what we're seeing and what we're exhibiting in the marketplace is not only policymakers talking about the importance of climate change, but we're also seeing both retail and institutional investors make decisions with their own capital. And so the tide is turning and it's happening very quickly, right? I'm just saying that it's just not going to happen on a dime, but there is strong momentum across the board, across everything that we look at, across both institutional capital flows, capital in terms of retail funding, questions and concerns by the retail channel and millennials alike, the focus, the time, if you will, of what's it called, investor relation departments as it relates to ESG, also the real estate that a lot of these companies are dedicating on their own corporate websites. So it is changing. There's a lot of hope, and I think that it's only going to build. The momentum is only getting stronger based on everything that we're currently seeing. So I wouldn't lose hope just yet. I think we're moving in the right direction.
Thank you. Are there any other questions? I don't see anything else in the chat. Anything living in the community here? I had one last question then, and it was about household savings rate. So I'm presuming when we talk about the percentages going up or down, that we're talking percentage of income. Is that how that is measured?
Yeah, it's percentage of excess, excess savings as a percentage of income.
Okay. And so why is that something that everybody focuses on? So like, what are they trying to get at when we're talking about it all the time?
I think what we're trying to point to is that historically speaking, the propensity to save versus spend has been more or less, consistent over time. And what we saw in 2020, for the most part, was a lot of forced savings. I'll give you an example. I would commute into Toronto 5 days a week, if not 6. I would consume everything that I was, my lunches, sometimes my breakfast, and sometimes dinner downtown, commute back home. Those costs were essentially banked during the pandemic and up until now, right? So, and then because we couldn't really do much with our savings at that time, it's not that we didn't want to, it's that we really couldn't. We couldn't travel. I currently don't feel comfortable traveling. I can't order certain products because they're in backlog due to supply chain. And so what's happened is we've seen an artificial increase in savings as a percentage of income. And so what we're expecting is that, again, similar to these transitory elements as it relates to inflation, there were some abnormalities that we've seen over the past year that we see or expect to normalize as we go forward. And so and again, we don't know exactly if that will happen, but I will say from my standpoint, we're heading back to the office. So that spending is going to continue to happen. It's
so you
going
think
to
there'll
increase.
be like a glut of spending? It'll represent, in this situation, consumers won't hang on to those savings. You think they'll put them back into their spending pattern?
I think there's some of it that's been used to pay down debts and other stuff. But I think the traditional habits that we've seen for the average, average consumer will move towards historical patterns. And it's not going to happen overnight. And it may not happen at the pace that we would have expected. But we're not making that call. We're just saying, even if it's a small fraction, it will be absolutely material in terms of what the impact will be, right? So I would say that's why people are focusing on it, because it's so well ahead of where we've seen historically. And one final point, we've seen for example, in the last federal budget, the federal government also make a note of that. And Canada's leading the pack as it relates to excess savings. So we've saved a lot more. And part of that is attributed to the fact that, at least for myself in Ontario, we've been in lockdown for a lot longer than other regions, if you will, right or wrong. I'm not here to complain. I would just say that we've saved a little bit more than other areas of the world.
Just to mention 2 things about this. The first thing is that we have 2 charts in the deck about savings. The first one is the one that Nadeem mentioned. We were showing excess savings, and that where we see Canada in number 1. But we also have a chart at the end of the deck talk specifically about Canada, and in that chart, we're showing savings as a percentage of disposable income. That's how Statistics Canada measures this.
Okay.
So we have those two measures of savings, and well, both are telling the same story. But I think we are, this one's for Canada. This is a percentage of disposable income, and it's at around 14%. And this one is just comparing what people wanted to have in savings with what they actually had. And that's how they measure, the IMF measures the excess savings.
Okay.
And one final thing, just to mention, the Bank of Canada also measures, or also have some assumptions or expectations on how those excess savings will, or how that all that extra money will go back to the economy. So they basically assume that it will go back to trend, and it's basically the same assumption that we have here. But they expect that in the short term, if I'm not mistaken, 20% of those savings will go back to the economy.
Okay.
Which, as Nadeem mentions, is a lot of money, and will definitely have an impact, and will be the first move in this adjustment back to pre-pandemic consumption patterns, if you will.
Okay. Thank you. And it looks like we have one last question. We've got a hand raised. Go ahead, Rochelle.
Okay. Quick question back in regards to climate change. My impression is that it seems like there's a lot of information about kind of targets at 2030, 2040, 2050. And what Nadeem was saying is that that change, those types of changes that are needing to happen will happen quite slowly and gradually. And my sense is that there's a tension between how quickly we're able to act in a sustainable way, while also needing to meet these kind of very real targets. So when I think about the financial market, my first impression is that we're looking at increased volatility. Is that true? Are there other things that we should be looking at? Like, I'm 35 years old, and I'm thinking, well, come retirement age, what will financial markets possibly look like if we keep going?
Yeah. So I think Bill Gates said it best. He goes, there's a huge opportunity. So I would say, as it relates to ESG, as it relates to these climate initiatives, these targets, or at least reducing global warming by less than 1.5 degrees by 2030, it's based on recent studies from the UN, and we published commentary on this. We're not going to meet that, right? So the world's probably going to warm by 1.5% sooner than that, within the next, if we especially look at carbon emissions and kind of the carbon credit system, if you will, based on how much we're emitting every year and what it would require, or how quickly we could actually breach those if nothing else changes. And I think within 8 years, we would already, less than 8 years, I think 5 years, we would actually breach that. What Bill Gates said was that the opportunity is quite tremendous. There's a chance that we can get maybe 5 to 10 Teslas coming out of this industry, easily another Facebook, Google, so essentially FANGs, but within the climate initiative, companies that are actually front and center and providing solutions. So it's a huge, as you said, there's a focus. And I'm telling you right now, according to the UN, we're probably not going to hit our goal by, the limiting warming to 1.5 degrees Celsius. So we're going to breach that for sure by 2030, guaranteed. Unless there's dramatic initiatives in place. And again, it's a balancing act, right? We cannot cripple major, and I think policymakers are aware of that they can't make too aggressive changes without facing the implications of those actions, right? On the economy, right? So it's a fine line, and it's going to take a lot of innovation, a lot of investment to kind of get us there. But I think for investors, there's a tremendous amount of opportunity for us to kind of seek out really compelling opportunities out there within this industry that is fast moving. Volatility, I think there's probably going to be more of that as it relates to additional regulations, if you will. So on sectors that are not evolving fast enough or are not implementing measures, I think there's going to be challenges. And I can tell you firsthand, across several industries that I follow, larger companies tend to have the capacity, have the resources to quantify and seek out opportunities, especially as it relates to climate change. But even broadly speaking on ESG, whereas smaller companies, small cap companies, don't necessarily have the bandwidth, resources, or capabilities to do that. So if you can kind of think about who or which companies are probably likely within an industry, take it telecom, take it financial, take the material space. I think smaller companies which are in these industries that are exhibiting these fast moving changes, and are likely to face heightened regulation will probably be the most at risk, as opposed to larger cap, well-capitalized businesses that have the resources, bandwidth, and scale to really adapt in a meaningful way should these regulations arise, and be more kind of aggressive in nature by policymakers or regulatory bodies, what have you.
Thank you. Thanks so much.
No problem.
I think, Rochelle, I like the word tension. And I think as I've been listening to this presentation and this last bit of dialogue, it seems to be that is the thing that I think is most exciting and most fascinating about this world of personal finance and economics, is that there's always tension. There's a tension between the pessimists and the optimists. There's the tension on the buy versus the sell side. There's the tension versus a short-term versus a long-term perspective. And I continue to find it fascinating. And I really appreciate the light that has been shed and the perspectives that have been shared by Nadeem and Luiz. Thank you so much. Thank you for staying at work so late for us, or wherever you're working. We really appreciate it out here in Vancouver. It's our earliest seminar yet, and I know there'll be hundreds of downloads by the time we get through posting this. So I really appreciate the energy and the wisdom that went into your presentation. Really grateful from Sophia Financial Group. Thank you so much.
It's our pleasure. Thank you so much for having us.
Thank you so much.
And to everybody else, I just want to remind you that our next Wise Money Talks webinar is Transitioning Through Divorce on Tuesday, November 23rd. If you have any friends, colleagues, or relatives who you think may benefit from this, please pass them the link. I'm the moderator of this, but also I speak about the financial implications. We have family lawyer Karen Redmond and divorce coach Sandy Hawkins who give their perspectives, and it's usually a very informative seminar and very helpful for those who are considering or have friends who are considering that kind of transition. So please pass on the word about Wise Money Talks, about our website, to your friends and your family. Thank you for joining us and asking these great questions with your thoughtfulness. I just love this community, and it's so great to see all of you. Have a great evening, and we look forward to seeing you again soon. Good night, everybody.